This week's tutorial, we're going to take a look at a past exam question on accounting measurement. So we're going to look at two narrative requirements around historical cost accounting, and then we're going to do a computational example, part C, which looks at three of the main normative theories of accounting measurement: historical cost accounting, current purchase power accounting, and current cost accounting. So the first one for 6 marks was list three requirements, or three criticisms, should I say, that can be made of historical cost accounting when it is applied in times of rising prices. Right? Well, the first one here we're going to put it down is the additivity problem. Right? That's a big problem because it adds assets together. So it adds assets together which were bought across different time periods. So what we mean by that, there is an additivity problem here. There's a bit of an inconsistency because the total figure is quite meaningless then. Because you're adding something you bought in 1980, you're adding something you bought in 1990, 2000. They could have all different, the same currency, but they're all different worth of money because, of course, inflation was different in different time periods. That's one key thing, right? So the next thing is that profits will be overstated. That's because cost of sales is based on historical cost. And also you have assets at historical cost means depreciation will be lower. Because if you're holding your assets at historical cost, it means depreciation is going to be lower. And it also means your cost of sales is going to be lower if you hold your inventory at historical cost. So it means your profits are effectively overstated. And what happens then is dividends paid on overstated profits will erode operating capacity. That's another limitation is, well, if your profits are overstated, then what happens is you'll pay out your dividends of those overstated profits. So you'll overpay your dividends and therefore you'll erode the operating capacity. You won't be able to buy the same level of goods in the next period, so you won't be able to operate at that same level of capacity. And one other limitation or criticism of historical cost accounting is it distorts holding gains. So for example, if you bought land in 1980 and it cost you 1 million, and then you sold it, put land there, you sold it then in the year 2019 and you sold it for 10 million. Well, if that was held at historical cost, you'd have a profit in 2019 of 9 million. So even though that land would have gained value each year, so what it was worth in 1990 was more than what it was worth in 1980 and so on, in the accounts under historical cost accounting, all of that profit is shown in the 1 year, which kind of distorts the year-on-year performance and gives a very good 2019 and no attribution to the movement in the holding gains over the period 1980 to 2019. So it is a limitation in how historical cost accounting works. That's our first point. We had 4 there, you only needed 3. The next one, part B, was looking at, notwithstanding part A, historical cost accounting has still maintained its position of dominance in how we do financial accounting. Why do you think historical cost accounting has remained the principal method? Well, one was the alternatives. I suppose the alternative pros were not convincing. So what we mean by that is the alternatives, your CPPA, your current cost accounting, we'll call them advantages. They just weren't convincing. There were still drawbacks in terms of CPPA. There were still drawbacks in terms of continuous accounting. So the cost versus benefit did not stack up. So although some people were proponents of these, it really didn't outweigh the benefits of historical cost accounting when they were looking at the alternatives. There was a reluctance to change. It would have required a fundamental shift in concept of profit or / income. So a lot of people were not comfortable with that because there was a reluctance to change. Look, people are used to, the people and the investors in the stock market were used to what historical cost accounting meant, and they weren't really sure that the alternatives gave superior information because they had limitations as well. And it was objective and verifiable, and that's an important one. So what we mean by that is, well, historical cost is the historical cost. You can go back and get a receipt or get an invoice of what you actually paid, so it is verifiable. When you move to somewhere like, for example, current purchase power accounting or current cost accounting, there's an element of subjectivity built in because you're now making these adjustments period on period, and you're trying to back up, well, is this, which index do I use for adjusting for inflation? What's the true accurate replacement cost? There may not be exactly one accurate one to get for the particular asset you're looking at. Whereas at least historical cost accounting could go back and say this was the price at this particular transaction date. And the last one is there's lower inflation in recent decades. Well, what we mean by that is the limit of historical cost accounting was really in focus in the 70s, 60s, 70s, where there was periods of high inflation. And this is where current purchase power accounting and current cost accounting evolved from. But as central banks got inflation under control, there was less of a focus on this limitation of historical cost accounting. And as we've had lower stable rates of inflation, it really has lowered the calls to remove historical cost accounting because it's not as distorted as it once was. So that gives you 3 or 4 additional reasons of why historical cost accounting remain the principal method. And again, you're looking at 6 marks for that particular piece. So your last piece then is the actual calculative piece. So if we go back and we have a look at it, we're given a company trading in 2018. And you're told they bought 10 items with capital of 9,000. During the month, they sold 60% of them, so they sold 6 items, and there's 4 items then left in inventory. And what you're given is a general index, which you're going to use for current purchase power accounting, and you're given the replacement cost, which of course you're going to use for your current cost accounting. And what you're asked is doing profit or loss and a statement of financial position using the 3 methods. So we would have done a similar type question in class, in the in-class example. So just to see, can you work through and see what the financial statements, even basic ones, look like for the 3 different accounting theories. So let's start then with the statement of profit and loss. We'll call it here statement of profit or loss. So we start with revenue. Now the revenue here, this is historical cost accounting. So we'll label this, we'll start with the basic one, the one that we're used to, and then we'll notice the changes between each one. So this is HCA. So the sales, again, that's quite straightforward. It's going to be you sold 6 items at 1,400. So you're told you sold 60% of inventory. If you bought 10, you must have sold 6. So that's 8,400. Your cost of sales then is opening stock, purchases, and closing stock, and that gets your cost of sales. So here we had no opening stock. We started with nothing. Purchases, we bought 9,000 worth of goods. I'll put there that was 10 times 900. You bought 10 goods with 900 each. That's use all your capital up front. And that means there's going to be 4 left, 4 times 900. You're valuing the closing stock at its historical cost. So your cost of sales then here is going to be 5,400, right? Which again is the 6 units that you sold at the historical cost. And that will get you to your gross profit. So your gross profit there, in this case the profit that we're going to use, we've no expenses, is revenue minus cost of sales, 3,000 euro. So you sold them for 1,400, you bought them for 900, which is 500 euro for 6 units each. Right, but it's just important that you understand what way we present it and what way it's laid out. So that's a statement of profit and loss. And then the statement of financial position. Similar format. We then have your assets. We have no non-current assets, but we have current assets. Your current assets, you have 2 of them. You have inventory and you have cash. And that will get you to your total assets. So the inventory here, remember you've done this already. The inventory is the closing stock from the P&L. You're valuing it at 4 times 900, which is 3,600. Your cash, you started with 9,000. You made purchases of 9,000. And then you made sales of 8,400. So you're going to have 8,400 left in cash at the end of January. Just be careful with that. You got capital in, you spent the capital, and then you sold 6 units at 1,400 each. So the total assets at the end of January are 12,000. And that will balance up with, if we come down here, the capital. So capital here, you have opening capital. We'll just call the capital the opening. The opening capital was 9,000. And you made profit, which is all distributable, of 3,000. And that is coming from the gross profit above. And that will balance then to your total capital with no liabilities of 12,000. So it's a relatively straightforward example, but just to make sure we know the difference between each one and we know what numbers look like in historical cost accounting. So it does balance. We compare the selling price to the historical cost. We have a profit figure, and all of that profit figure is distributable. That means you can pay that out as dividends if you so wish. So that's your first one, looking at historical cost accounting. What we're going to do now is we're going to take that same template and we're going to bring it over here, and we're going to look at CPPA, current purchase power accounting. And we'll delete some of these down just so we can set it up. So in current purchase power accounting, we're saying we're not focused on maintaining financial capital, we're focused on maintaining purchasing power. And what we do is we take the historical cost accounts, i.e. the ones we've just done here, and we adjust them for inflation. And we use a general price index. We don't adjust each one by a different index. So this is a general price index adjustment, and we're going to use the one that's given in the question. So firstly, we're going to look at the revenue. The revenue in historical cost accounting was 8.4. So I'll make this a bit bigger here. Was there 8.4? So we're going to say here, it's going to be 8.4 divided by the index when it was sold. The sales happened in the middle of the month. You divide by 123 and you multiply by the end of month index because the prices have risen. So if those sales had taken place at the end of the month, they would have been 9014, or we'll round there to 9015. So you're saying because the sales took place during the middle of the month, you have to bring them to what the value would have been at the end of the month. For your purchases, you take the 9,000, which was the historical cost. You divide that by the index when the transaction occurred. You acquired them at the start of the period, which is 110, and you bring it towards the end of the period, which is 132. So your purchases there, we have no opening stock. Your purchases, 9,000 divided by 110 times 132 is 10.8. And your closing stock, be careful, is the same adjustment, 36 divided by 110 times 132. Because that inventory is now brought forward. So you're bringing each of them forward to account for the increase in the price levels overall. So that is your cost of sales there are now 6480, and your gross profit is 2534 or 2535 if you're rounding. So that's your first element here, right, is to adjust each of them for the general price index. Now the additional thing we have in CPPA is the gain or loss on monetary items. In this case, it's going to be a loss on monetary items. So in CPPA, if you go back, what we have is when you have cash on hand, that cash will lose value as prices increase because the amount of stuff that the cash can buy decreases as prices increase because the cash doesn't change. You made sales of cash of 8.4 during the period. So to calculate this, we're going to go to working one. All right. So what we're looking at here is we had cash of 9,000 at the first day and we spent it straight away. So that doesn't have any implication really because the minute you got it in, you spent it on inventory. What does have an implication is you have cash of 8,400 from the sales that came in middle of January. All right. So in the middle of January, that 8,400 was cash. However, it was still 8,400 at the end of January. The problem is everything else has risen in price. So that means the purchasing power of that 8.4 has decreased. So the 8.4 divided by the rate when it was brought in the middle of January times the end of month rate means it's now 9015. So what we mean by that is something that would have cost 8,400 in the middle of January and that you could have afforded with the 8,400 you got in from your sales is now expected to cost 9015. The fact that the cash is still valued at 8400 means you have a loss in purchasing power of 650. Loss in purchasing power. So that's important. Although we're increasing, we're saying that's what the price has gone up by. The fact that you have cash sitting in your bank account that hasn't moved means that you've lost money. And that loss goes in here to give you your profit overall for CPPA of 1920. So that's something that's brand new in CPPA that would not be in historical cost accounting. That you're recognizing if you had monetary liabilities like debt, then they would gain value if prices are rising. So it works the opposite. Monetary assets, such as cash, lose value when prices are rising. Monetary liabilities, such as debt, gain value. And then we do our current assets. Inventory, we're take directly from the question, 4320. Whatever is in the P&L must be in the balance sheet. And cash, remember, does not change. That's the one to watch out for. Monetary items, they're still the same monetary item. Right? It does not change when you go to the statement of financial position, when you go to cash, because it's still 8.4 in the bank account. The assets do, but not this, because that's a monetary item. And that's an important distinction in CPPA. The opening capital, just be careful, is 9,000 divided by the rate, what was there at the start, which is 110, and times 132. So 9,000 divided by 110 times 132. So the capital now adjusted for inflation is 10.8. And you add your profit, which you've adjusted after the monetary loss. That gets you, when you round, to 12,720 as well. So you know your total capital is balancing with your total assets. Now that's a bit trickier because you're bringing in the concept of adjusting for inflation and you're bringing in this loss in monetary items that you need to be able to calculate. So certainly make sure you go back and look at the CPPA slides, that you make sure you understand where that logic is coming from and why we distinguish between monetary items, which have a gain or loss with inflation, and non-monetary items like inventory, which do not. All right, that's the second one done. So we're going to take that again then, and we're going to do the last one, which is current cost accounting, otherwise known as replacement cost accounting. So in current cost accounting, we don't do generic price indices. We adjust for the actual current cost or replacement cost of the asset. All right. So we're going to do a small couple of adjustments here. So we go back then, the revenue does not change, it's still 8.4, which is your 6 times the 1400. So the revenue is not updated for inflation or anything like that, it's only the replacement costs that are updated. The cost of sales now, we don't look at opening stock, purchase and closing stock, we just look at cost of sales. You sold 6 units and the replacement cost when you sold them, be careful, 950. So the cost of sales there is 5,700. So that means your, what we call, be careful here, the operating profit. So we have a different terminology when we use current cost accounting. The operating profit is 2.7, and that's what will be available for distribution. So you cannot distribute more than the 2.7. Right? But we also then have holding gains. You have realized and you have unrealized. So the holding gains relate to the fact that you're going to revalue these assets upwards. The inventory that you bought at 900 is now 950 or 960. The realized holding gains relate to the assets that were sold. So those 6 assets that were sold, they have been revalued from 900 up to 950 because you only bought them at 900, but you're actually only recognizing profit at 950. That other 50 profit is called a realized holding gain, and that will be 50 times 6, 300. But these holding gains are separated because they're not allowed to be distributed. But remember we said the rule in class, if you add together the operating profit and the realized holding gain, that is the same as the historical cost profit, 3,000. And you'll see that match there. The unrealized gain is different. This is where you're revaluing the assets that are left. Instead of valuing inventory at historical cost, you're going to value it at 960, which is the closing replacement cost at the end of January. So that is something we don't ever have in historical cost accounting. We always leave closing inventory at the 900, as we have here. But in his current cost accounting, they revalue it upwards, and that will be 60 times 4, which is 540. And when you add the operating profit and the holding gains, we call that then the business profit. That's the terminology that's used. But note, the business profit, is not all distributable. The only part of that can be distributed is the 27. So that's an important distinction, because if you distribute either of these, you're going to erode the operating capacity of the business. So they only want you to distribute the operating profit, which is calculated importantly based on the replacement cost. So if you come down, then your inventory is going to be measured, be careful, 4 units left at 960. So you're measuring at its closing replacement cost, which is the 960 here, and that's how you've revalued it upwards in the holding gains. The cash doesn't change, it's still 84, giving your total assets 12,240. The capital also doesn't change. Unlike CPA, we do not adjust for inflation, we only adjust for the replacement cost of the assets. And the profit then is your business profit, 3,240. And that thankfully gets your total capital to be 12,240. But remember there, only 27 of this is distributable. So that's an important distinction. You cannot distribute all of that 3,240. You can only distribute the operating profit. The holding gains are calculated to show the rise in the value of assets, but they're not allowed to be distributed, because if you did, you would have that limitation of historical cost accounting where you would erode the operating capacity of the business, meaning you couldn't buy the same level of goods next year because you don't have enough money. So what we wanted to focus in is look at the difference then. How these statements will look: the profit, 1932 or 27, and then 3,000 for historical cost accounting. Even though it's the same business, the same transactions, all right, for the same month, you can have 3 fundamentally different P&Ls and 3 fundamentally different balance sheets. And that's the whole idea of what we call normative theories of accounting. They're telling you this is how it should be done. This is really how we're currently doing it, historical cost accounting, but there are alternatives and they have pros and cons. So you need to know, as we said in class, the concept. What's the concept of each of those accounting theories? The calcs. What are the steps of how to go about doing calculations? And this is as hard as it'll get. So you don't need to worry about too more complex than this. And then the pros and cons. What's good about them, what's bad about them, and have an awareness of why historical cost accounting is still the dominant framework that's used. All right, so that was this week's tutorial looking at a past exam question on accounting measurement.